Hello, and welcome to the show. I'm your host, and today we are tackling a topic that sounds incredibly technical, but it's one that quietly influences almost every part of our financial lives. I'm talking about the DXY Index.
It's great to be here. And you're right, it sounds intimidating, but it's a concept that everyone can and should understand.
Exactly, because most of us have had that feeling, right? You've wondered why the dollar's value just seems to move like a tide. One day, planning an international trip is affordable, and the next, it's suddenly 10% more expensive. Or you look at the price of imported goods, or even just the gas in your car, and you wonder, what is driving this?
And a huge part of that answer lies in the DXY. You can think of it as a barometer for the dollar's strength. It's not just some abstract number for traders. Its movements ripple out and affect real-world inflation, global investments, and even the interest rates on foreign debt.
So today, our goal is to demystify this. We're going to break down what the DXY actually is, what's inside it, what makes it move, and most importantly, how it impacts the global economy, especially in regions like Latin America. By the end of this, you'll be able to read that headline, "The DXY rose 1%, and know exactly what that means for your wallet. What is the DXY?
Okay, let's start with the absolute basics. What exactly is the DXY? The DXY, or the US Dollar Index, was created back in 1973 by the Intercontinental Exchange. Its whole purpose was to solve a simple problem. How do you measure the dollar's strength? Before the DXY, analysts had to compare the dollar against a dozen other currencies one by one, which was messy.
So the DXY combines them all into one number.
Exactly. It measures the dollar's movement against a basket of major foreign currencies. It started with a base value of 100 points back in 1973. So if you see the DXY at 110 today, it means the dollar has strengthened 10% against that basket since the 1970s. If it's at 90, it's weakened.
You mentioned a basket. This is the most interesting part to me. What's actually in this basket?
This is the key to understanding the DXY's behavior and its limitations. It's a weighted group of 6 currencies. You have the Japanese yen, the British pound, the Canadian dollar, the Swedish krona, and the Swiss franc.
Okay, but you left one out.
I did, because the 6th one is the most important, the euro. And it's not an equal split. The euro makes up almost 50% of the DXY's entire weight.
50%. So you're saying the DXY is in large part just a reflection of the dollar versus the euro?
To a huge extent, yes. If the euro weakens against the dollar, the DXY will rise significantly, even if the dollar is doing nothing against the yen or the pound. This composition is its greatest strength and its greatest weakness.
That's a great point. What's not in the basket is just as telling. You won't find the Chinese yuan, the Brazilian real, or the Mexican peso in there.
Correct. It's an index heavily weighted towards developed European economies. So while it's a great measure of the dollar's strength against that specific group, it doesn't always capture the full picture of what the dollar is doing in emerging markets like Latin America.
What moves the DXY? Okay, so we know what it is. Now, what makes it move? The DXY's value isn't random. It's reacting to news. What are the big drivers we should be watching?
There are a few powerful forces, and the first one is by far the most important: the Federal Reserve, or the Fed.
Interest rates.
Interest rates. Think of it this way. When the Fed raises interest rates, it's like putting up a giant neon sign for global investors that says, "Get higher, safer returns here." This encourages a massive flow of capital into the United States. But to buy those U.S. assets, what do they need?
U.S. dollars.
They need dollars. That huge increase in demand for the dollar strengthens it, and the DXY goes up.
So a hawkish Fed, one that's tough on inflation and raising rates, is a strong dollar Fed.
Precisely. The second driver is just broad U.S. economic performance. When U.S. data on employment or GDP growth is strong, it builds confidence in the dollar and the index rises.
That makes sense. What else?
The third driver is monetary policy in other economies. Remember, the DXY is relative. If the European Central Bank is cutting its rates, making the euro less attractive, while the Fed is holding steady, the dollar looks better by comparison, and the DXY will rise.
It's the cleanest shirt in the dirty laundry analogy.
Exactly. And that leads to the final and perhaps most powerful driver, global risk scenarios.
The safe haven effect.
That's it. In times of high uncertainty, a financial crisis, a pandemic, a geopolitical conflict, investors flee from risky assets. They sell their stocks, they sell emerging market currencies, and they rush to buy the one asset they see as the ultimate safe haven, the U.S. dollar. We saw this in 2008 and in the late 90s. In a crisis, the dollar strengthens and the DXY shoots up.
The so what? Global and local impact. Okay, so this is the part that matters most to our listeners. The Fed raises rates, the DXY surges. Why should someone in Peru or Mexico or just anywhere outside the U.S. care?
This is where the DXY stops being a number and becomes a real-world force. The impact on emerging economies is massive, and it flows through three main channels.
What's the first one?
This is the first one that affects everyone. Commodities and imported inflation. Most major commodities, oil, copper, grains, are priced in U.S. dollars on the global market.
Right.
So if the DXY rises, the dollar is stronger. That means your local currency is weaker. Suddenly, it takes more of your local currency to buy the same barrel of oil. That higher cost for fuel, for electronics, for imported medicines, that's imported inflation. It directly raises your cost of living.
And that hits everyone, whether they invest or not. What's the second channel?
This one is even more dangerous. Foreign debt. Many emerging market governments and large corporations borrow money in U.S. dollars.
But they earn their revenue in their local currency.
You got it. So let's say the DXY rises 10%, your local currency falls 10%, your revenue in pesos or reals is the same, but your dollar-denominated debt payment just got 10% more expensive. It can crush budgets and strain finances.
That sounds like a vicious cycle.
It is a vicious cycle because that leads to channel 3, capital flight. When international investors see this, a strengthening dollar, rising U.S. interest rates, and growing debt stress in an emerging market, they get nervous. They pull their capital out of those emerging markets and move it to the perceived safety of U.S. assets. This selling of the local currency makes it even weaker, which makes the debt problem even worse.
So the DXY rising can literally dictate the economic policy for an entire nation. A central bank in Latin America might be forced to raise its own rates, not to fight its own inflation, but just to try and stop that capital flight.
That is the dilemma they face. Risk inflation or risk a recession. It's an incredibly tough spot, and it's often dictated by the DXY.
Practical actions and conclusion. Okay, so this is fascinating and honestly a little terrifying. It feels like the whole world is just reacting to the Fed's decisions. So for a regular person listening to this, what's the takeaway? What can we do?
You can't control the DXY, but this knowledge empowers you to make smarter decisions. It's not about predicting, it's about preparing.
What does preparation look like?
First, diversify your savings. If you live in an economy that is vulnerable to these currency shocks, it's simply prudent to hold a portion of your long-term savings in a more stable asset. For many, that means holding some dollars or dollar-denominated assets.
That makes sense. What else?
Second, evaluate your debts. If you have the choice, try to avoid taking on significant debt, like a home loan, in a currency that you don't earn. If you earn pesos, it's almost always safer to borrow in pesos.
And finally, just pay attention.
Just pay attention. You don't need to become a trader. But the next time you hear a Fed announcement on the news, don't tune it out. Your first thought should be, okay, they're raising rates. The dollar is likely to get stronger. How might that affect my grocery bill or my savings over the next 6 months? That proactive mindset is the whole point.
So, to summarize, the DXY is the